Welcome to another BAR walkthrough video from SuperfastCPA. I'm Logan, and in today's video, we are going to be going over BAR Area 2. This is Section I. This is an application topic. Calculate the amount of lease income that a lessor should recognize in the income statement. And we're going to be doing that the SuperfastCPA way, which is diving straight into the questions to learn the material. Now, if you don't know much about our strategies, make sure you go to SuperfastCPA.com and sign up for our free 1-hour webinar training. In that 1 hour, we will teach you the key ingredients to passing the CPA exam so you don't waste months or even years of your time failing exams. And then after you watch that, you're going to want to learn more. So make sure you also check out becoming a Superfast CPA Pro member. Pro members get access to the full versions of these videos. So in today's video, we are only going to be doing 5 questions, but Superfast CPA Pro members will get access to the full 10-question version of the video when we post it in the member forum. So if you like this and you like our other videos and our other products, make sure you check out becoming a Superfast CPA Pro member. Now with all that, let's dive straight into the questions. All right, here we are at question 1, and something I always like to point out is you want to read the last sentence of a question first. This is a very good habit, a very good strategy to have, especially for test day, because frequently the last sentence gives you context for what the question is actually about. It's kind of usually like the real question. So by doing this, you will more easily know what you're dealing with in each question, and that will help you be a little bit quicker. So let's do that here. How much lease income should Northwind recognize in its year 1 income statement? Let's go up to the top. On January 1st, year 1, Northwind Properties enters into a 5-year operating lease of retail space with a tenant. The lease requires annual payments of $24,000, but the first 6 months are rent-free, making the very first payment only $12,000. Payments begin on July 1st, year 1, and are made annually thereafter. Okay, so again, how much lease income are they going to recognize in their year 1 income statement? Now, they had 6 months of free rent. Is that going to affect this? How much are they going to recognize out of the $12,000 payment? However you want to look at it, what are they going to recognize? If you know how to do this, that's great. If you have no idea though, that's okay. We're going to take a look at the explanation now. All right, here we are at the answer B, $21,600. So they're not going to recognize $24,000. They're not going to recognize $12,000. They're going to recognize $21,600. So let's think about this. Under ASC 842, which by the way, you don't really need to know the numbers. I just like to throw that out there sometimes. Lessors recognize lease income from operating leases on a straight line basis over the lease term, regardless of when cash payments are received. Okay, so we have to figure this out. The total payment, so the total amount of money they're going to receive is $24,000 for the 4 years that there's full rent, and then the $12,000 for the first payment, which was for only half of a year because the first 6 months were free. So $12,000 plus $24,000 times 4 is $108,000. And again, that's because there's $12,000 that was for the 6 months that were free that they're not getting paid because it was free. But the lease term is 5 years. So how do we figure out how much income they're going to recognize over the lease term? It's really simple. You just take the $108,000 that they're going to receive over the course of the lease, divided by the 5 years of lease, and that's $21,600 per year of revenue that they're going to recognize. So even though in year 1, they only got $12,000, and in year 2 and 3 and 4 and 5, they're going to get $24,000, each of the years they're only going to recognize $21,600. So again, therefore, even though the tenant pays nothing in the first 6 months and makes a $12,000 payment on July 1st, they recognize $21,600 of lease income in year 1. So that's how to recognize lease income when there is some kind of a promotion where, they get some of the rent free. Now let's go to the next question. All right, here we are at question 2. How much interest revenue should Pine recognize in its year 1 income statement? Let's go up to the top. On January 1st, year 1, Pine Leasing Co. enters into a 4-year finance lease with a customer. The equipment was purchased by Pine for $80,000. The lease requires 4 annual payments of $25,000 with the first payment due on January 1st, year 1, at lease commencement. The implicit interest rate is 6%, and the present value of the lease payments is $88,500. So again, how much interest revenue are they going to recognize in the year 1 income statement? If you have no idea how to do this, if you don't know how to calculate this, that's okay. We're going to learn how to do it, but if you have an idea, maybe pause the video and give it a try, and when you're ready, come back, we'll look at the answer together. All right, here we are. The answer is D, $3,810. That's how much interest revenue they're going to recognize. Let's go through this to teach you how. For a finance lease, which is what this is, it says it was a finance lease, the lessor recognizes interest income using the effective interest method applied to the outstanding lease receivable or the net investment. So the net investment at commencement is $88,500. That's the present value of the lease payments at commencement. The first payment is made on January 1st, year 1, right at the very beginning of the lease. It's $25,000. And because it's right at the very beginning, it reduces the receivable by the full amount. There's no interest. It's all principal. So $88,500 less $25,000 is $63,500. Now, at the end of the year, as the interest builds up, they are going to be building interest up with 6% based off of the $63,500 because it's been that for the whole year. So the interest is actually $3,810. It wouldn't be based on the $88,500. So they recognize a $3,810 interest revenue in year 1. So with that, now let's go to the next question. All right, here we are at question 3. What amount of profit should Oak recognize at the commencement of the lease? Let's go to the top. On January 1st, year 1, Oak Leasing Co. enters into a 3-year sales type lease of equipment. The equipment has a carrying amount on Oak's books of $70,000. The lease requires 3 annual payments of $30,000 with the first payment due at commencement. The implicit interest rate is 5%. The present value of the lease payments is calculated at $82,000. So think about this. We talked about some of this in question 2. Do your best to think through this, and when you're ready, come back. We'll look at the answer together. All right, here we are at the answer D, $12,000. So this is a little bit different than what we did in question 2, but some of the same elements. In a sales type lease, which by the way is a finance lease, but it's one of the different finance leases for a lessor, the lessor recognizes profit or loss at commencement equal to the difference between the present value of lease payments and the carrying amount of the underlying asset. So present value of lease payments, $82,000, carrying amount of the equipment, $70,000, so the profit is $12,000. They recognize a $12,000 profit at commencement of the sales type lease. Now, one thing I will say, if for some reason you're not given the present value of lease payments, but you're given the cash payment, like the cash amount that was paid for the equipment, that is frequently used in place of present value of lease payments, and you compare that to the carrying amount of the equipment. But a lot of times you will see the present value, and so you compare that to the carrying amount to see if there's a profit or a loss at the commencement of the lease, if it's a sales type lease. So we learned a little bit more. Now let's go to the next question. All right, here we are at question 4. What is the total interest revenue Maple will recognize over the 4-year lease term? Let's go to the top. On January 1st, year 1, Maple Leasing Co. enters into a 4-year finance lease. The implicit rate is 10%. The present value factor of an ordinary annuity of 1 for 4 years at 10% is 3.170. The present value of the lease payments is $63,400. So what is the total interest revenue they're going to recognize over the 4-year lease term? Okay, so this is different than what we've talked about so far. If you have any idea how to do this, that's great. But if you have no idea what's going on, that's okay. We're going to use the explanation to learn what we're doing. So let's go ahead and take a look at the explanation. All right, here we are at the answer C, $16,600. So this is pretty simple once you know how to do it. So let's figure this out. The annual payment actually is $63,400. That's the present value divided by 3.170. And that gives us the payment that was used with the present value factor to get the present value. So we're just kind of reversing things. You would normally, to get the present value, do 20,000 multiplied by 3.17. But since we had the present value already and the present value factor, we were able to figure out the annual payment that led to that. Now we can figure out how much cash is collected. 20,000 multiplied by 4 equals $80,000. So over the course of the 4 years, $80,000 of cash will be collected. And the total interest revenue is going to be the $80,000 of cash less the actual present value, and that's $16,600. That difference there is the interest that is going to be received or paid over the course of the life of the lease. So again, $16,600 of interest revenue. That's how you do that. Now let's go to the next question. All right, here we are at question 5. What amount of profit on sale is recognized at the commencement of the lease, and what amount of interest revenue is recognized in year 1? So this is kind of a combination of what we've talked about so far. On January 1st, year 1, Willow Leasing Co. enters into a 4-year sales type lease. The equipment has a carrying amount of $85,000 and a cash selling price, or the fair value, of $100,000. The present value of lease payments plus any residual also equals $100,000. So the fair value and the present value, including any residuals, is $100,000. The lease requires 4 annual payments of $28,000 with the first payment due on December 31st, year 1. The implicit interest rate is 6%. So again, what amount of profit on the sale is going to be recognized at the start, and what amount of interest revenue is going to be recognized at the end of year 1. So take everything we've learned about so far and try to do this, do the best you can, give it a best guess, or try to figure it out. And when you're ready, come back, we'll look at the answer together. Okay, here we are. The answer is D, $15,000 profit and interest of $6,000. This is, again, very simple once we've understood how to do this from the other questions. Profit is just the fair value or the present value, and we have both at this point, of $100,000 less the $85,000 carrying amount, so $15,000 is the profit. Lease receivable, again, $100,000, and that's how much it is at the start of the lease. So the lease receivable is the present value of the payments, $100,000, and we take that, multiply that by 6%, and that gives us $6,000 of interest. So of the $28,000 received, which is how much each payment is going to be of the 4 annual payments, $6,000 of it is interest this time, and $22,000 of it is principal. So that means that they have a $15,000 profit at the start and $6,000 of interest revenue over the course of the first year. So again, that one was kind of a combination of some of the things that we've learned in the other questions. And with that, we've gone over 5 questions. Now, before we do anything else, let's do one more part of the SuperfastCPA process called Pillar Topics. Now, the idea behind pillar topics is as you're going through the questions to learn the material in your review course, you will notice the things that keep popping up in the questions. You've seen 2 or 3 or 4 questions trying to teach you how to calculate the profit at the start of a lease, or how to calculate the interest revenue for a lease, or whatever the case is. Again, you notice these things as you're going through the questions, and so you take a moment and write these out in your own words, and you write them out as the pillar topics, the key points based off of what you learned from the questions. And as you're doing this each day, you are building your own personal repository in your own words based on the things you learned that were most important from the questions so that you're ready for the exam. So let's go ahead and take a look at the pillar topics for this video. All right, here we are at the pillar topics. Let's just dive straight in. Again, this is kind of like the basic ideas, the key points based on what we learned in the first 5 questions. First off, operating lease income is recognized on a straight line basis over the lease term. Rent-free periods are spread across the term, so revenue is the same each year regardless of cash timing. And basically what that's saying there is if you have rent-free periods, that is going to affect how much is the total across the lease term, and then that total for the lease is what you're going to divide by the full lease term, like the full lease in years. For finance leases, the lessor records interest revenue using the effective interest method on the net investment. If the first payment is at commencement, that would be an annuity due, by the way. Year 1 interest accrues on the post-payment balance. And if it's at year end, it accrues on the full opening receivable. And again, just making sure you understand that. If the first payment is on the first day of the lease, then that first payment is all principal and then interest starts building. But if the first payment isn't until the very end of the first year of the lease, or halfway through or whatever, then the interest will have time to build up based on that full amount that the lease started with. Now, in a sales type lease, profit at commencement equals the value assigned to the receivable, whether that's cash selling price or the fair value, or the lower of fair value and present value of payments, minus the carrying amount of the asset. The receivable is measured at that same value. And that's kind of what I was trying to say. You'll probably see the present value of payments, but it could also be the cash selling price or the lower of the fair value or the present value of payments. Compare that to the carrying amount, and that gives you the profit. Now let's go to the next one. Total interest revenue over the life of a finance lease equals total cash collected minus the present value recorded at inception. When given present value and a present value factor, solve the periodic payment as present value divided by present value factor, then compute total cash. And then finally, first year mechanics. With end of year payments, year 1 interest equals the opening receivable multiplied by the rate. And we kind of already talked about this. With an immediate first payment, that payment is all principal and interest starts accruing on the reduced balance. And again, we kind of mentioned that before. That's the difference there is if it's at the very beginning, then that first payment is all principal. If it's not at the beginning, then interest starts accruing. Now with that, we've gone over the pillar topics for this video. And again, these are kind of like the main ideas, the basic ideas that we pulled from the first 5 questions. And that is the end of the YouTube version of this video. Remember, on YouTube, we're only doing 5 questions and the pillar topics, but SuperfastCPA Pro members will get access to the full 10-question version of the video that I'm about to finish after this so that they can get a little bit more help and a little bit more understanding. So again, if you like this, make sure you check out becoming a Pro member. Now, the easiest way to learn about and become a SuperfastCPA Pro member is by going to SuperfastCPA.com and signing up for our free 1-hour webinar training. In that 1 hour, we will teach you the key ingredients to passing the CPA exam, and then that will give you a great path to learning about and becoming a SuperfastCPA Pro member. So again, check out the webinar, check out becoming a Pro member. I hope this video was helpful. If you liked it, make sure to like it and leave a comment, and I will see you in the next one.